Oof, glad that's over. Mr. Market hit the red button this week with nearly all major global indices taking it on the chin. The only notable exception was the CSI 300, but that hasn't exactly been rich hunting grounds lately. Shiny defensive stuff seems to be holding its worth well, as a lot of global uncertainty appears to have reinvigorated the safety trade. Oil continued its triumphant run in the wake of capacity and supply concerns and geopolitical risk. More on this below. All sectors of the S&P 500 were down, with only 28 members of the S&P 500 up on the week. The index was led by the gamers, more on that below as well, with the losers led by Netflix. Following a largely inline Q4 result, the attention quickly focused on their Q1 guidance, where global streaming net paid ads of 2.5 million came in well below the consensus of 6.9 million. A string of downgrades followed by the banks, and the stock ended up having what I believe is its worst day ever. All this red is hurting my eyes. Let's move on. The video game industry is back in the news following two high-profile acquisitions in the past 2 weeks, leading to speculation that there may be a rush to acquire more assets in the face of increasing consolidation. Things kicked off with Take-Two's proposed deal to acquire Zynga for $12.7 billion. Take-Two, primarily a PC and console player with such notable titles as Grand Theft Auto and the 2K Sports franchise, followed the trend of traditional developers targeting assets in the high-growth mobile space, where the big guys seem to be on the back foot as far as presence. The deal terms for Zynga, the Farmville and Words with Friends creator, saw its shares pop nearly 50% on the announcement, but it's worth noting the $9.86 offer price is still well below the $12 we saw them at last March. And this week saw Microsoft following suit, with the Xbox developer making a move on the controversial Activision Blizzard. Activision shares jumped nearly 30% on the announcement of the $69 billion deal, which goes down as the largest acquisition the company has ever made. Some in the media are voicing concerns about the deal as potentially harmful to Microsoft's culture, as Activision is invested in an ongoing SEC investigation and a lawsuit brought on by the state of California alleging pervasive frat boy culture at the company, including sexual harassment and female discrimination on pay and promotion. Since word broke in July 2021, more than 40 Activision employees have reportedly been fired, and the situation weighed heavily on its shares. Like Zynga, even with a healthy takeover premium, the deal price still falls well short of the stock's 2021 highs. Microsoft execs appear to be fine with the controversy, as analysts see Microsoft's ambitions in the space to be to turn its Game Pass subscription service into the Netflix of gaming. What does this mean for the space? Well, it looks like the sector's hot again. After a string of big deals in the mid-2010s, the space has been sort of a dead zone for large-scale M&A until things picked back up in 2020. Since then, the run of billion-dollar deals has accelerated, coming to the point where the last 10 days have seen the two largest deals in the history of the sector. For competitors, particularly the smaller ones, this could be a bad sign, as larger players holding the platform and distribution channels could create walled gardens, severely hampering their peers from profitably reaching customers. Even GameStop had its name pop up as a potential victim of the deal, as potentially more sales will move directly through the Microsoft pipes and out of the hands of the retailer. So on Wednesday, the last of the big banks finished reporting, and let's just say I've seen prettier earnings seasons. The space averaged declines of 8% over the 5 preceding trading days ending on Thursday, and no one was spared. The two biggest investment banks, Goldman Sachs and JP Morgan, led the way down for the group. JP Morgan missed smalls on revenue but put up a double-digit beat on earnings. Still, that wasn't enough to get them out of the hot seat after the CFO talked down guidance for the year to come due to increased expense expectations mostly associated with labor costs. The shares closed down more than 6% on the day, which was its worst reporting day in recent memory. Goldman had a tidy beat on revenue, which was up 8% for the year, but missed on earnings per share by more than 8%. Just like JP Morgan, the talk was mostly about increased talent expenses going forward, and just like JP Morgan, they had their worst earnings day in more than a decade. A lot of these names are up big over the last few years, so heading into some uncertain times, such as inflation, both economic and employment, it seems like a lot of investors are cashing out for greener pastures. With anxieties building in Europe, particularly in relation to its largest energy producer, energy markets have been in a bit of a tizzy lately. Things cooled off on Wednesday as Biden pledged to push oil prices lower and spare consumers the pain at the pump, potentially releasing some of the strategic reserves that had only started to rebuild for the first time in 8 weeks. The oil price, now comfortably in the 80s, is already up almost 15% for the year and at its highest level in 7 years. Jeff Curry, head of commodities research at Goldman, currently has a target price of $105 oil by the second half of the year. And while the European situation should be concerning to everybody, let's be clear that it's not the only thing going on with oil. Markets have been tight for some time due to production disruptions and significant underinvestment in the space for years, for reasons varying from ESG reallocations to weak profitability from the low oil price. As a result, reserve capacity is tight and demand is noticeably ahead of supply. The net effect of all this is what analysts are calling a triple deficit: low inventory, low spare capacity, and low investment. So where will the new capacity come from? The International Energy Agency forecasts that new capacity from the US, Brazil, and Canada could walk us back from the edge, But as it stands, the only two nations able to have a meaningful short-term impact on production, according to Goldman Sachs, are Saudi Arabia and the UAE. The darling of the initial lockdown appears to be in significant trouble, like Matt Wilper's double hill climb sprint at the end of Class Trouble. After peaking at nearly $170 last January, shares sunk to the mid-20s this week as concerns around demand keep snowballing. Most recently with the news on Thursday that they will be halting production of all connected products, bikes, treadmills, smart weights, the whole shebang, as it sees demand evaporated in the saturated market. Management has since come out to deny that claim, so we'll have to wait till February 8th when they announce their Q2 print to see where things are really at. This isn't a new development, however. With the reopening of gyms and strong competitor launches, Peloton's Q1 print in November saw the stock drop 40% in 3 days of trading after it confirmed strained demand and chopped its 2022 guidance. And the street has been more than fine with taking them at their word, slashing sales estimates consistently over the last few months, with the consensus estimate now sitting below the company's target band. So, heading into the next quarterly release in just over 2 weeks, things look pretty straightforward for Peloton to post its third straight quarterly loss. Shareholders are going to need a meditation class. Alright, so that's all I got. Thanks for watching, and if you enjoyed it, please give it a like and maybe even consider subscribing. I'm Ryan, and thanks for tuning into Market Lab.